Now time to take a look at option markets and contracts. I do think options are perhaps a little more involved than the other derivatives that we've dealt with, at least at level 1. The level 2 stuff and the swaps does get a little bit intricate also. But here you have to think of an asymmetric contract. So when we talked about futures and swaps, essentially we had payoffs that could be described by a straight line. We'll actually look at one of those, the FRA, as we go through this. And then we'll talk about the asymmetric nature of the option payoffs. Now, the thing to remember is that we have an option buyer and an option seller. So unlike the futures contract, where the contract has a zero value at initiation, the option has a value. So we have someone who buys a contract and someone, of course, who sells a contract. Can't have a buyer without a seller. So when we talk about option pricing, we are talking about the price of the option contract. When we talk about futures pricing, we're talking about the price at which the underlying will be exchanged. So the price at which the underlying will be exchanged is just one of the contract terms. When we get to options here, we call these the call premium and the put premium, and you'll see those on the next slide. But remember, if we have an option buyer, that's someone who has a right but not an obligation to enter a transaction, then we must of necessity have a seller. That's someone who is obligated to perform under the terms of the option contract. Now we'll deal with two kinds of options, and those are I guess the only ones that I know of anyway. So I guess this is a complete set. So we'll have call options. That is, the long here, or the buyer of the option, has the right but not the obligation to purchase the underlying asset at the exercise price for some period of time. The short, of course, has the obligation to sell or deliver the underlying asset at the exercise price if the holder of the option chooses to exercise. So the holder of the option, of course, will choose to exercise when it is in his or her best interest. So the call is the right but not the obligation to buy. The put then is the right but not the obligation to sell at the exercise price. So you can think of a call option as being a bullish position. That is, the long is going to benefit when the price increases. You're locking in a price at which to buy today. You're hoping the price goes up above that in the future. The put option is a bear position. That means that you're locking in a price at which to sell. So you're hoping the price will fall. You can buy in the market and then sell to the contract through the put option. So put options are a bet. If you're long a put option, you're betting that the price of the underlying will go down. Now, in the way of terminology here, a couple of things to keep track of. An American versus a European option. An American option can be exercised at any time up to and including expiration. A European option can only be exercised at expiration. Now, if that's the only difference in the contracts we're looking at, one's American and one is European, then obviously the American option has to be worth at least as much as an otherwise identical European option. Why is that? Well, you can do everything with an American option that you can do with a European option, plus you can do one more thing. That is, you can exercise early if you decide that that would be advantageous. So a couple of points on this. One, these are just names, American and European. Most traded options, regardless of where they're traded, are American options. So it doesn't have anything to do with where they're traded. They're just names. Actually, I think that comes out of an old joke in option pricing somewhere back down the line. Okay, the other thing that you might find to be a little bit strange about this is that while most traded options are American options, okay, most of our pricing models are European pricing models. So we price European options primarily in our pricing models, even though American options are the order of the day in terms of what is actually traded. How can we get away with that? Well, the notion here is that there are very limited circumstances under which the early exercise of an option will be optimal. That is to say that most American options are going to be exercised at expiration, so we are essentially ignoring the early exercise privilege when we talk about option valuation, and if we're using a European model. So anyway, most of our option pricing assumes exercise at maturity only. However, remember that is something that's different between theory and practice. We can bring in the idea of early exercise also. We just don't see that in our option pricing models that you'll look at as you go through the curriculum. All right, now, this next term, I want to remind you that I didn't think this up. So moneyness, that always has seemed like a strange word to me. Okay, but what we're talking about here is whether an option is in the money or out of the money, which of course is terminology that we borrowed from horse racing. So if we're talking about a call option here at the top, the S, if you're used to thinking of stock options, then think of the S as standing for the stock price. Okay? Usually it is used in a more generic term to mean the spot price, or the price at which the asset can be traded today. But nonetheless, we'll think of it as a stock option. Maybe that will help as leverage some of your existing intuition. So what happens if at the expiration of the option, the stock price and the exercise price are the same? That is, you have the right to buy something for $25, that's the exercise price, and it's actually worth $25. Well, that is an at-the-money option, and of course, it doesn't have much value. It has zero value at expiration. But on the other hand, if we had an exercise price of $25 and a spot price or stock price of $30, okay, well then what do we have? Well, we have a price in the market of $30. We have the right to buy it at $25. Okay, so we could go in the market and buy it we go to the contract and buy it at $25 and then sell it in the market at $30 and make $5. So this S minus X, okay, is the way we denote the terminal value of an option. Okay, so if S minus X is greater than 0, then there is going to be a payoff to the option. And of course, if we have the other situation, that is where S is less than X, so we have the right to buy something for $25, it's actually only worth $20, well, we're obviously not going to exercise that option. Even if we wanted the stock in our portfolio, we wouldn't exercise the option and buy it at $25, we just go in the market and buy it at $20. So an out-of-the-money option, okay, or an at-the-money option has a zero payoff at maturity. I should say, well, that's true. An at-the-money or out-of-the-money option has a zero payoff at maturity. If we're talking about call options, if S is greater than X, then the payoff at maturity will be S minus X, and that's a pretty lousy S, but nonetheless. So put options, of course, will be different because they are a bearish position. So now, remember, we're looking for the value of the asset to fall. We've locked in a price at which to sell. So if we have an exercise price of 25, the stock is actually worth 25. Well, it doesn't do us much good to buy it in the market for 25 and put it to the contract for 25. Okay, but what if the stock price falls? So what if the stock price falls to 10? Well, then we could go out and we could buy this for $10 and put it to the contract at 25, and we would end up having a terminal cash flow of $15. So the put option is in the money. That is, the terminal value is positive when S is less than X, and we frequently describe the payoff to an in-the-money put as X minus S. And that's just the exercise price minus the spot price. An out-of-the-money option, of course, has a terminal value of 0. So anyway, keep that in mind. The moneyness of the options, that tells you something about whether they are in the money or out of the money, and we'll work with that concept several times as we go through this material. Okay, looking at a quick example here, what we're doing is we're dividing intrinsic value from time value. And while we have this explicitly later in the slide deck here, what we're going to see is that the value of an option, let's call it a call option here, okay, I mean, this would also be equally true for a put, is going to be a combination of two things. Okay, an intrinsic value, I'm going to put IV for intrinsic value. So that is simply the amount by which the option is in the money. So we're looking at an option prior to expiration here, and we're saying, well, what is the intrinsic value? Well, that's just going to be, for a call option, our S minus X, and if we're talking about a put option, then it would be X minus S. So the value of the contract is going to be equal to this intrinsic value plus what we're going to call a time value, all right? So the time value is the reflection of the fact that if you had an at-the-money option, the right to call option, the right to buy something for 25, it's currently trading at 25, well, it's at the money, and if it were expiring today, the payoff would be 0, but the value of that option is greater than 0. Why? Because it has the potential to be in the money sometime before expiration. So all we're really doing on this slide is breaking the value of an option down into two parts. One is the intrinsic value, and the other is the time value. So let's look at the example. So the stock price here is $47. We have a call with an exercise price of $50. Okay, so we have the right to buy this at $50. It's currently selling for $47 in the market. Would you want to exercise your call option? Would you exercise your right to buy this for $50 when it was actually trading for $47? Well, of course not. If you wanted the stock, you'd go in the market and buy it for $47. But notice that the option still has value. That is, it has a value of $1.50. So what we're going to do here is simply break this out into intrinsic value and time value. Since this option is out of the money, okay, well then, so the intrinsic value is 0. all of the value associated with this option then must be time value. And it's this time value or calculation of the time value which makes option pricing a little bit difficult. You won't see that at level 1, but that's where the Black-Scholes option pricing model comes into play, which you may have seen elsewhere. So anyway, so the time value of this option is the same as the value of the call option. Why? Because it is out of the money, so the intrinsic value is 0. On the other hand, if we're still looking at a stock that's trading at $47, but we look at an option with an exercise price of $45 that's currently trading at $3, well, now this option is in the money, right? So if we take S, the stock price, that's 47, subtract off X, the exercise price of 45, then we get a $2 by clearinghouse, just like we saw with the futures contract. Okay, options are also traded in large volume over the counter. Okay, these are customized contracts. They are unregulated, and of course, since they are just private agreements between counterparties, there is going to be counterparty risk associated with an OTC option. What about the different types of options out there? Well, what we've talked about so far has been the idea of a stock option, and that's what many... If you're not a CFA candidate, the kind of option that you're most familiar with is probably a stock option, and that probably stems from the idea of employee or executive stock options, the right to buy into the company if it does well as a result of your personal management genius. Okay, but we can have other types of options too. So we could have a commodity option, so that's the right but not the obligation to buy gold. Okay, we can have an option on a fixed income security, so this works just like a stock option. It's the right but not the obligation to buy a bond at a fixed exercise price. Of course, what drives the value of the bond is going to be that the interest rates are falling, right? So if interest rates fall, the value of the bond goes up. So if you're buying a call option on a bond, you're essentially betting that interest rates are going to fall. Okay, what about index options? Well, index options, of course, are another type of option. Okay, these typically have a multiplier. So like we saw with futures contracts, they have a multiplier of 250 for every index point. The option is in the money at expiration. So once again, it's just the right to buy the index at a fixed price. So if you had the right to buy the index at 500, it had gone up to 502. So it had gone up 2 points. Well, you'd take the 2 points that it was in the money, multiply that by the multiplier of 250, and you would see that you had a payoff of $500 associated with that. Now, if that weren't enough, okay, we also have, so these are all options on some sort of fundamental underlying asset. Okay, we can also have options on other derivatives. In this case, an option on a futures contract. So an option on a futures contract takes two forms. You have a call option, okay, and this, of course, gives the option holder the right but not the obligation to enter a futures contract as the long at a specific futures price. So if you think you might want to get into a futures contract in the future and you are thinking you want to specify a price in which you can get in today, well then you could buy a call option on a futures contract. Conversely, a put option gives the option holder the right but not the obligation to enter the futures contract as the short, okay, as being the indicated futures price. So at exercise, the futures position is mark to market. So if you exercise into your futures contract, it's in the money, you exercise, you'll receive those cash flows from it being in the money immediately. And we talked about mark to market in just the last reading. So anyway, so those are different types of options. A couple of other specialties here, the things you're going to see on the exam. An interest rate option. I think that these play a significant role on the exam, so you want to make sure you get a handle on this. But remember, just like we talked about futures contracts being directly on an interest rate versus on a fixed income security, well, when a long futures contract was in the money when interest rates went up, okay, a long futures contract on a fixed income security was, and I used the wrong term when I said in the money, a long futures contract would win when interest rates went up, okay, if it was directly on the interest rate. A long futures contract on a fixed income security has the inverse relationship thing going, right? So if interest rates go down, okay, then your futures contract would be in the money as the price of the bond went up. Here we're looking at an option directly on the interest rate. So we talked about options on bonds a few minutes ago. This is the analog to that. Now we're talking about options on interest rates. So the payoff is based on the difference between a floating rate, which is going to be LIBOR on the exam in all likelihood, and the strike rate. Okay, the payoff is when it's a call is going to be a call is going to be in the money when the rate floats up above the strike rate. So the payoff for a LIBOR-based interest rate call option is given by this formula. Okay, the maximum of the strike rate maximum of 0, or LIBOR minus the strike rate times whatever the notional principal is. We might also have to adjust that for periodicity if they said that LIBOR was 180-day LIBOR. So the long is going to win when interest rates increase, okay, and we will try an example of this in a couple of slides. Okay, for the short, for the payoff to the put, not the short, so this is the long put, okay, well, the payoff is going to look very similar. Okay, the only difference is going to be the reversal of LIBOR and the strike rate. So what we're hoping now is that we're going to get a payoff, okay, when LIBOR goes below the strike rate. So the strike rate or the exercise rate is analogous to what we've been talking about with other options. And if LIBOR goes down, okay, then that spread becomes positive and the put will receive a payment. Now, one important thing to note here is that the payoffs are made at the end of the interest rate term. So if we bought, that is, we're long an interest rate call option on LIBOR, and the LIBOR went up above the strike rate, okay, well, what kind of LIBOR? If it was 180-day LIBOR, well, then when we determine what the payoff is, we'd still have to wait 180 days to receive our payment. Please contrast this in your mind with the FRAs that we were talking about earlier. So when you looked at the futures contracts, okay, we took the FRA, we calculated the payoff in the future, and then we had to discount it back to the expiration of the contract. We don't do that with interest rate options. We calculate the payoff in the future, and then we just wait for the future to get here, and we receive the payment in the future. All right? So, and we'll see, like I said, we'll see an example of that in just a moment. Okay, now, what about this FRA thing? So we were just reminded of the FRAs on the last slide. If we're talking about a long FRA, remember that was essentially the long is obligated to take a loan and the amount of the notional principal for the term of the interest rate that we have as the underline. Well, what that means is that as interest rates go up, okay, then the long FRA is going to win. So if we're looking at LIBOR here on the horizontal axis, we're looking at the payoff on the vertical axis. Okay, well, what happens if we if we have an FRA that has a price of 5%, that means that's the contract price or the fixed price, and interest rates end up exactly at 5%. Well, then we're going to borrow at 5%, and we are going to lend at 5%, and that's not a way that you're going to make a lot of money, right? Okay, but what happens if LIBOR gets bigger? Okay, so what happens if LIBOR goes up to 7%? Well, then as the long, I have the obligation to borrow at 5, but I can turn around and lend out at 7, so I'm going to have a profit, that is a positive payoff, okay, when interest rates go up above the exercise price, okay, or up above the contract price, excuse me. So what about if interest rates fall? Well, then if interest rates were to fall to 3%, I have to borrow at 5%, loan at 3, I have a negative spread, and I'm going to be losing money. The point is that the payoffs to the FRA can be described as this straight line with a 45-degree angle here, right? So as interest rates increase linearly, the payoffs to the FRA are going to increase, and the same will work on the downside. Well, the notion here is that we can take two interest rate options and we can combine them to make one FRA. So if we had an interest rate option at 5%, that would say if interest rates fell below 5%, okay, what would our payoff be? Well, we have a call option at 5%. If interest rates end up at 5% or below, then the payoff is equal to 0. As the interest rates go up above 5%, then we're going to get a payoff that looks like this, right? What if on the other hand we had a short contract? So we're looking at a put option here. So we have a short interest rate put is what we would need. That's what I was looking for. So if we had a short interest rate put, well, if it's short, what's going to happen if we are above the exercise price? Then we'll be over here, right? But if you're short the put, as interest rates fall, you're going to end up paying. So the long put would have a value going up like that, right? So it's a bear position. As interest rates go down, you would lose, you would win, okay? But now what's going to happen if you're short? Well, just the opposite. You're going to come down this way. Well, if you take the orange line and the blue line and put them together in terms of a red line, then what you get is these two interest rate options, the long call and the short put, are equal to one FRA. All right, so you get this straight line, and I think I can animate that for you. So we can see that here we have the long put, the long call. So that's the payoffs to a call. We're going to look at hockey stick diagrams later on if you're not familiar with that, but that is the payoff to a long interest rate call. Here is the payoff to a short interest rate put, okay, and you put the two things together, that is the long call plus the short put, then the payoff starts to look like a straight line here. That is to say that we can replicate and FRA with 2 interest rate options. Now, why would we want to do that? Doesn't really tell you in the level 1 curriculum, but what we're going to see is that we use replication to price a lot of these securities. So if we didn't know how to price an FRA, but we did know how to price these 2 interest rate options, then we would be able to work from the two option portfolio to the price of the FRA. Okay, what about interest rate caps and floors? Okay, well, interest rate caps and floors are simply a series of interest rate call options. So if you understand call options, you understand caps and floors. Caps just mean that we're going to have a series of these call options. So a cap puts a maximum on the issuer's payment from floating rate debt. So we've talked about that back in fixed income. And we said, look, if you have floating rate obligations, as interest rates go up, then your payments are going to go up. As interest rates go down, your payments go down. Well, what if you issue some debt when interest rates are, we'll say about 6%? Okay, well then what if interest rates go up to 10? Well, you might be able to stand variability up to 10%, but if it gets above 10, it's going to stress your cash flows. Well, what you could do is buy a cap in such proportion that it would make the interest payments above 10% if in fact interest rates went there. So like I said earlier, this is just equivalent to a series of long interest rate calls, and so the short is going to make payments when the floating rate is above the strike rate, right? So whoever is the owner of the cap is going to receive payments when the floating rate is greater than the cap strike. Okay, so a floor puts a minimum, does the same thing, only now we're putting a minimum on the payments that we would receive from interest rate from a particular interest-sensitive asset. So this is equivalent to a short interest rate put, okay, or a series of short interest rate puts. So here, if you are long the floor, okay, if interest rates fall below the cap strike, or below the floor strike, then you are going to end up receiving payments, all right? So looking at the payoffs here, and well, what we see here with this straight line, okay, is simply the loan rate that we would pay if we just issued floating rate securities. So we issued floating rate securities. Well, here's interest rates today. Okay, if interest rates go up, then our payments go up, right? If interest rates go down, our payments go down. As interest rates go to 0, our payments could go to 0. So that's great. It's just a straight line, right? What we're doing here with the cap and floor is saying, look, what we could do is we could take this and say, well, we can accept variability in this range. But if interest rates get up to here, they get up to 11, 12, 13%, that's going to cause serious problems with our company. And well, then we can buy protection against interest rates going up, and the way we would do that is to buy a cap. So we would cap interest rates at 10%. We'd set the notional principal equal to whatever our outstanding issue was, and we can't keep interest rates from going up. Interest rates can go up to 11%, but as they go above 10, we're going to receive inflows that will offset the damage that we would receive. All right. So that's one way to think of this. All right. What we could also do is, what we're trying to do is buy some protection from interest rates going above 10%. One way we could one way we could finance that would be to sell a floor. So what we could do is say, look, we're going to sell someone else protection against interest rates going down here. So if interest rates go down here, well, that's going to be really good for us. Okay, interest rates go up here, that's going to be bad for us. Well, maybe we can truncate some of these bad states of the world by giving somebody else the benefit if we have cash flows that go way down here. So there's someone else who has floating rate assets, and if interest rates fall too far, their income is going to be down. They would want to buy a floor. So that would be the idea behind the floor buyer. So what we're going to get is we're going to have, if we are short a floor, okay, and we are long a cap, then what's going to happen is interest rates for us are going to vary in this range as we see here. Okay, so interest rates are between 5 and 10%, then they vary just like it's a floating rate note. If they go above 10%, we receive payments. If they go below 5%, then we're making payments. So we get this kind of odd-shaped exposure to interest rates. But we have no exposure to interest rates below 5% or above 10% if we are long the cap and we are short the floor. All right? So caps and floors, one way to view interest rate options. It's just a series of interest rate options. Let's try to calculate a payoff together really quickly. So we have a long 60-day call option on 90-day LIBOR. So 90-day LIBOR is the underlying interest rate. Make sure that you know that that's the periodicity of the underlying nominal loan, right? So it's a 90-day loan that's going to be at stake if we're using 90-day LIBOR. So the notional amount is going to be $1 million. The strike rate is 5%. So we're long the 60-day call. What that means is 60 days from now, we're going to look at interest rates. If they are above 5%, then we're going to receive inflows. So these are the above this long red line, those are the things that are known at expiration. Okay, what happens when we get to expiration? So 90-day LIBOR at expiration goes up to 6%. Well, this interest rate option then is in the money. So how much is going to be paid and when is it going to be paid is the next question. Well, of course, all we're going to do is we're going to say, look, we've got a spread of between 5 and 6%. So we were protecting ourselves against interest rates going up above 5%. They have, in fact, gone to 6%. So that's going to be our 1% spread. We have $1 million notional principal, and we just have to make sure that we adjust for the periodicity of the loan. So we're going to take the notional principal times the interest rate spread. If you're Andy Holmes and you're under duress in the exam, okay, then what you forget is the time adjustment. Make sure you don't do that because it makes a big difference. Okay, so anyway, what we see here is a payoff of $2,500. Now, if this were an FRA, we would take this and we would discount it back to the beginning of the period. Okay, that is at the end of the 90 days back to the end of the loan contract. Okay, but that is not what we do with interest rate options. Instead, okay, these are just paid. This would be paid by the writer 90 days after the expiration of the option. All right? Okay, so looking at option value, well, we've already talked about this first relationship up here. The option value is a function of two things. Okay, that is its intrinsic value and its time value. So the intrinsic value here for a call is going to be S minus X. If it's in the money, for a put, it's going to be X minus S. Okay, and remember, if you're working with a call, you take S minus X, and that turns out to be negative, the call is out of the money. The option holder will walk away. So it's S minus X. If that's a positive number, is the payoff to the call. It's X minus S is the payoff. If it's a positive number, the payoff to the put. The time value, of course, this is just the idea that this is the option premium minus the intrinsic value, and we already talked about that. Okay, so also called its speculative value, although I don't see that term used very often. I usually see it associated with the term time value. How about some notation here? And then we can talk about some pricing bounds, and then we'll be able to look at what it is that drives an option price. So option notation, okay, well, S, of course, is going to be the value of the underlying asset at time T. So you can think of that as the stock price. Okay, of course, more generally, that would be the spot price, or the price at which you can buy the underlying asset. X is the exercise price. That is the price that you can either buy at if it's a call option or sell at if it's a put option. T is the time to maturity. So this is going to be stated in the portion of a year. So 1 would mean 1 year, 0.5 would mean 6 months, the risk-free rate, and then these are the call and the put values. So notice that we use a capital C and a capital P to talk about an American call and put, and a lowercase c and a lowercase p to talk about a European style put. So anyway, so this notation is going to become important when we talk about option pricing, and we'll talk some about the sensitivities going forward here, and you'll see a lot of that at level 2. All right. Now, what about pricing bounds? Okay, this is an exercise in logic that you can go through, and you can say, well, what's the maximum price an option can trade at? What's the minimum price it can trade at? And then, if you wanted, the analysis is relatively shallow here, but we can actually take this and slice it down considerably smaller intervals than what we see. Anyway, so let's look at the call option first. I think that's the easier one. So what is the most a call option can trade for? Well, think of this as an option where you have an exercise price, we'll call it $10, okay, and we have a stock price of whatever that happens to be. We'll just set it for $10 right now. I may change that later on. Well, what's the most this option could trade for? Well, what this is saying is that it'll never trade for more than $10, right? You're not going to buy an option to buy a stock for $10 and then pay more than $10 for that option, right? So the maximum that an option can trade at is up to its stock price, the current stock price or current spot price. So the maximum is going to be S. What about the minimum? Well, the minimum is going to be basically the amount by which the option is in the money, right? So we take S minus X. Okay, well, that's the amount by which it's in the money. Of course, if that's less than 0, then we would have a 0 lower bound. Okay, but think of this as being in the money. So if we change this so that the stock price is equal to $11, okay, well, then we have S minus X is $1. What we're saying here is you're not going to see this trade below its intrinsic value, but actually it's going to be a little bit lower than that because you could structure an arbitrage relationship to capture the time value for these options between having to exercise now versus exercising in the future. Okay, so what about the puts? Okay, well, the put, so if we change our example now and we look at a put and we say, okay, we have an exercise price on this put equal to $10. Okay, and we have a spot price so for this put contract equal to, well, we'll start out with $10 here also. Okay, well, what is the maximum that put can be worth? Well, remember, if the stock price goes to 0, okay, then you're going to get $10. So the maximum that you can earn with this option is $10. So the exercise price is the limit of the profitability to the long put. So if we had an American style put, then if we buy it yesterday, we have an exercise price at $10. Today the company goes out of business, so the stock price falls to 0. Well, we could get $10, and there the exercise price is the upper bound for the American option. Of course, with the European option, as you see down here, with the European option, even if we have a put option contract, a European put option contract that allows us to exercise, that is to sell the underlying for $10. Okay, if the price falls to 0, we still have to wait until the expiration of the contract in order to be able to get our $10, so the maximum will be a little bit lower there. Looking at the minimums for the put contract, well, what you see again here is you see the intrinsic value, X minus S, and the same logic applies to being able to structure the arbitrage so that the notion of having to wait for the payoff is going to make it a little bit greater than that here for the minimum for the put option. All right. So anyway, these are called pricing bounds. Okay. My experience, people struggle with these just a little bit. So I think if you'll think through them and create some little examples in your mind like we've done here, you'll be able to see where those payoffs come from. Okay. And sometimes if you draw a timeline, it also helps. Here's the stock price. Okay, and we're going to be able to exercise here. Well, remember, we got to bring the exercise price back. That's where the discounting comes from. So anyway, if you think about a little example, I think you'll be able to get on top of this. This is something I would know for the exam. I think it is something some people ignore, and therefore I think if I were writing questions out of this reading, this is something that I would test. All right? Okay, so moving forward here, so options that differ only by exercise price. So first of all, we're going to look at put options. So we're looking at two puts. Well, remember, a put is a bare position. What you want to be able to do, all else equal, is to sell the stock or put the stock to somebody else for as big a price as possible. So if we're looking at puts that are identical in all respects other than exercise price, then the one with the higher exercise price is going to have at least as much value. The way we could say that, with ignoring one trivial point here, that when they're both the same, is that the one with the higher exercise price is going to be worth more. So all else equal, would you rather be able to put the stock to someone for $20, or would you rather be able to put it to them for $30? Well, all else equal, I would rather be able to sell my stock for $30. So the higher the exercise price, the greater the value of the put. Okay, what talking about call options here? Well, if we're talking about two call options that are identical in every respect other than exercise price, then the one with the lower exercise price will have at least as much value. And again, ignoring one constraint, and so we don't have to worry about the at least as much, what this is saying is the lower the exercise price, the greater the value of the call. So all else equal, would you rather be able to buy the underlying at $25? Or would you rather be able to buy it for $20? Well, if you're buying, you want as low a price as possible. So the lower the exercise price, the higher the value of the call. Just the opposite for puts. The higher the exercise price, the greater the value of the put. All right. So that brings us to a very important concept for the exam. That is put-call parity. So this is something that I would want to make sure that I had a handle on. What we're going to essentially do is we're going to put together two portfolios. One of these portfolios is a protective put, which is nothing more than buying a stock and then long a put option on that stock. So if the price goes up, you still have the stock. If the price goes down, you can put that to somebody else. Well, what we would see is we'd have a payoff like this. So if the stock fell, we'd get the exercise price from the put, and if the stock goes up, then we get the upside value to that, right? Okay, so that's the protective put. We also have a fiduciary call, which is a call option plus a bond where the face value of the bond is equal to the exercise price. Okay, so we're going to discount that back to today. So this is the bond is sometimes called, or the discounted value of the exercise price is sometimes referred to as the bond. So you're buying a zero coupon bond with a face value of X, and you're paying this discounted value for it today. Well, if the value of the underlying falls below the exercise price, then the call is out of the money, and all you end up with here is the X that you get from the zero coupon bond. But as the call goes into the money, then you receive the payoff over X, so you get a portfolio that goes up like this. Okay, well, what's the point of all that? That seems a little bit cumbersome to go in and talk about a protective put and a fiduciary call. Well, the point is that both of these portfolios, okay, the protected put and the fiduciary call, have exactly the same payoffs in all states of the world, which means if they have the same payoff, they must have the same value. That is to say, the protected put, the stock plus the put option, has to have exactly the same value as the call plus this, or the fiduciary call, which is the call option, plus the discounted value of the exercise price. So this is put-call parity. Okay? And the thing to remember here, and this is not a good idea by a well-meaning economist. So if you look at this, what you have is you have an underlying, that's a traded value. You have a put contract, that's a traded value. You have a call option, that's a traded value. And then you have something based on the interest rate that is also traded. So all of the inputs into this formula are traded values, which means that it is bound by arbitrage, right? So of course, there would be some corridors here on different borrowing and lending rates and bid-ask spreads and all that sort of stuff, none of which we're concerned with in the curriculum, okay? But this relationship has to hold subject to those minor deviations, all right? So what does all that mean? Hey, well, here is our original version of the contract up here, or excuse me, a version of the identity here. That is, we have the protected put and the fiduciary call. Well, what we can do is we can just use a little bit of algebra to rearrange this. And in particular, the way it's going to most likely be used on the exams is to get a put price. So if you know the value of the call, you know the value of the stock, and you know the interest rate, so you can discount back the exercise price, then you can find the value of a corresponding put. That is, the put on the same underlying security with the same exercise price and the same time. So this is the relationship between puts and calls, and it's called put-call parity, of course. Okay, so what we can do here, of course, is go back and say, well, this is the put, and this other part here, the call option minus the stock plus the value of the bond, okay, that is called a synthetic put. So both sides of the equal sign have exactly the same payoffs in all states of the world, so they have to have exactly the same price. Otherwise, there is going to be an arbitrage opportunity. We could also solve this for C and get synthetic calls. We could even solve this for S and get synthetic stock, or solve it for the exercise price and get a synthetic bond. So it doesn't matter which one we solve for, they're all going to be the same, although I would focus on this aspect, that is, given the call, find the value of the put. So here's a quick example. So looking at this, we see that the stock XYZ is trading at $75. So that is S, right? So this is our stock price, S. Okay, we have a call premium of $4.50. That's our C. Okay, the call is going to expire in 4 months. That's a third of a year. The exercise price is $75. So now we know the exercise price. We also know the term to maturity, and we know the interest rate. So if we know these last three, we know the exercise price, we know the risk-free rate, we know the term to maturity, then we can find the discounted value of the exercise price, right? So we can just take 75 and we're going to divide it by, 1 plus the whatever in order to come up with the discounted value. So what we want to know is, what is the value of the corresponding put? Well, if we go back a slide, okay, well, we know that the put is equal to the call minus the value of the stock plus the discounted value of the exercise price. Okay, so we end up with this. Okay, so there's the formula. We plug in, here's the call value, subtract the stock, add in the discounted value of the exercise price, okay, and we get $3.29. So once we know the call, assuming we know the value of the underlying, we can always price the corresponding put, and this would be something that I would think is likely for the exam. So it's something that I would not ignore put-call parity. This is something that should go on your formula sheet on page 1. All right? Okay, so put-call parity. Be aware of that. Know how to use it. The derivation, you're kind of up on your own there. I'm not sure how important going through the derivation is. The notion is both of those portfolios have exactly the same payoffs. Once you make that intuitive leap, the law of one price tells us that the protected put and the fiduciary call have to have the same value. All we've done here is solve for the value of the put so that we can create the synthetic put over here. All right, so what about time, volatility, risk-free rate, and the strike price? Okay, so time, the longer the time to expiration, the greater option values are. That applies to both puts and calls. Okay, so there's some exception here for far out of the money options with European style puts. Okay, but I don't think that that's something you have to worry a whole lot about. Okay, what about this idea of the risk-free rate? Okay, well, the risk-free rate increases the value of the call, it decreases the value of the put. I think the logic here is a little bit harder to see, but if we're talking about a call option, what are our options here? We think there's a stock trading at $20. We think it's going to go up in value. How can you capture that the value created by your position there? That is, you think the stock's going to go up, you want to capture that upside value. Well, you could go out and buy the stock. So you could pay $20, so you go out and buy the stock and pay $20, right? So that would be one option. Okay, the other option would be to buy a call option. So if the call option, it's at the money, it's currently trading for $2, well, you can either invest $2 and buy the call option, okay, and capture the upside potential, or you can buy the stock and pay $20. The difference is 18 bucks. What are you going to do with the difference there? Well, the notion is if you buy the call option, okay, then you get to invest the difference during the term of the option. So the higher the interest rates, the more attractive the call option becomes. All right. Now it's a little harder to see with the put option, but you basically have the same thing. How can you profit from a notion that the value in asset's going to fall? Well, one, you could go in and you could buy a put. I'll put that as a P. The other is that you could short the stock, right? So I don't have enough room here to write short. Maybe I do. Okay, you could short the stock. Well, the notion is if you short the stock, okay, so it's trading at $20, you sell it, then in the terms of option pricing anyway, it may be hard for individuals, but if you are a big institution, you can do this. Okay, you're going to get the $20. What are you going to do with the $20? You're going to invest it. Okay, so you're going to earn the interest rate on it. So as interest rates go up, it makes shorting look more attractive relative to the put. So if an increase in the risk-free rate is going to decrease the value of the put. And my experience is that people struggle with the influence of the risk-free rate, especially as it is associated with puts. So my suggestion is get the intuition down for calls, and then just remember that puts is just the opposite. Okay, we've already talked about differences in exercise price. The higher the exercise price, the lower the value of the call. Did I say that right? Yeah, the higher the exercise price, the lower the value of the call. The higher the exercise price, the higher the value of the put. Okay, so we went all the way through these. The one I didn't talk about was this one, which was volatility. Okay, we've talked about that previously just a little bit, but here as a quick reminder, okay, so we'll get myself some room to write. So as a quick reminder of the influence of volatility, well, if we're looking at volatility over time here, and this is going to be, spot price on this axis, and then we have, the exercise price here. Well, what would you rather have? Would you rather have a stock that has low volatility? It goes up and down, it can go anywhere, but it goes up and down like that. That's a low volatility stock. So if the stock's up here, then you end up making money if we're talking about a call option. If it finishes out of the money, then you walk away and let it expire worthless. Or would you rather have a stock that does something like this? Okay, something that's much more volatile. Well, now if the stock price runs way up, then you get S minus X, okay, and that's going to make for big profits, right? On the other hand, if the stock falls to a really low price, what do? Well, then you walk away. So in other words, you have big profit potential at the upper peaks, but you don't have offsetting loss potential at the lower peaks. Therefore, the higher the volatility, the greater the value of the option. So the way we sometimes say this is that options are a volatility play. So if the volatility of the underlying asset increases, okay, then we are going to see the value of the option, regardless of whether it's a put or a call, increase in response to the increase in volatility. So increased time, that's going to make puts and calls more valuable. Increased volatility, that's going to make puts and calls more valuable. So keep those in mind. Okay, finally here for the option stuff. Hey, what about if the underlying assets pay some sort of cash flow? Well, up till now, what we've really been working with, although we didn't state this explicitly, was an asset that doesn't have any underlying cash flows. So if the asset does have positive cash flows over the period of the option, the cost of the asset is reduced by the present value of the cash flows. So if we were going to go in and do an option pricing model, instead of putting in the stock price S, what we would do is we would plug in S minus the present value of the cash flows. And I think this is actually best interpreted as an approximation, but nonetheless, that's the rule. So if we were going to have some sort of, a pricing model, which we are not using at the level 1 exam, then rather than just putting in S today, we would have to substitute the net cost, that is the stock price minus the present value of the cash flows that we would receive during the option period. Okay. Okay, that's options. So like I said, I think these are sometimes a little more troublesome to people. The notion here is that they have these asymmetric payoffs. That causes a few problems. So we'll see that you have to be careful with that. And we'll come back later in the material and we'll have another look at some option payoffs right at the end of the derivatives material altogether. So good luck with this material.